Hello and welcome to today's premium account market update for the ASX Top 50, September 2019. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals, have 24 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation, we look at the ASX Top 50 with a review of FY 19 earnings and outlook into FY 20. We look at the technical trends, portfolio allocations, and conclude with a short-term outlook for the Australian market. Investor Signals Premium Account Service is where we manage the broking portfolio on your behalf. We work in partnership with you to determine the model portfolio allocations within the ASX Top 50 and Top 100 stocks. We utilise call options to enhance portfolio returns. We're very much focused on effective ownership around ex-dividend dates, generating above average cash flow from a combination of the dividends and the call options, still looking for capital growth, all in a strict investment mandate, and importantly the assets remain in your name. If you'd like to know more about the premium account service, please contact me on the 1300 number or leon at investorsignals.com. Moving straight into a graph of the XJO, the Australian market with interest rates falling globally, we're likely to see another push higher in equities as the market, I think, is willing to sort of give the soft global economic data the benefit of the doubt that the central bank stimulus that we've seen now from both China, Europe, and this week likely to be US rate cuts in the US should help to push equities marginally higher. The Australian market from a technical perspective is under sell signals, although it's broken up to make a new high, and we'd expect over the course of the next sort of 3 months to see that switch to a buy. If we have a look at the patterns within the main international markets, looking at the Nasdaq index, which is one of the more important leading indicators of the market at the moment given the above average earnings growth that's coming from the tech stocks in the US. But the Nasdaq's under algorithm buy signals. We had that signal back in May, and the market's rallied about 10 to 12% since then, created a higher high, another higher low, and momentum seems to be fairly bullish there at the moment within the Nasdaq. The S&P's under sell conditions, but a little like the ASX is breaking higher, making a higher high. We expect to see that switch back to a buy condition. Now, importantly, the Dow, so we've got the Nasdaq under buy conditions as well as the Dow Jones. We've seen the higher high, higher low pattern here. We've got the buy signal in the Dow at around 25,000 points, now pushing up to 27,000 points, and within the Dow Top 30 there's a number of stocks that we quite like as far as concentrated US portfolio exposure at the moment. With today's recording, the focus is ASX Top 50, so we go into the watch list, select ASX 50. We can arrange these in alphabetical order. We'll start with AGL, and I'll move through these fairly quickly and just share with you my thoughts. AGL, a lot of bad news is now priced into this, so a fall in earnings in something in the order of around 10 to 13%, I think, is what the market's priced in. Probably the bad news is priced in for the time being. Interest rates moving lower. A utility like AGL, there's an opportunity here. Own it. Don't see it doing too much more than trading back above $20. So as it pushes up towards that level, I'd look to sell covered calls to enhance the return. You're going to kick the cash flow up to about 10% per annum through the dividend and the call option income. We're not doing here with Aristocrat at the moment. The stock's mostly moved sideways over the last few years, but it's not one that we hold in the model portfolio. Amcor, I've been commenting on the blog over the past recent days that Amcor's a high conviction addition to portfolios. The company's buying back $500 million worth of shares. They've completed the merger with Bemis Group. There's $160 million of cost synergy savings to come through. Obviously, the counter argument here is a slower global economy. Why do we need more packaging today than we needed yesterday? And I think for that reason, that's played into the sell-off in Amcor. It was getting expensive from a PE standpoint. Back down here, it's on about a 4.5% dividend yield. The company only delivered, if you sort of strip out the Bemis numbers and just look at the original Amcor business, underlying earnings growth was only tracking at around 3%, 4%. But I think a combination of that share buyback, the cost synergies, and giving the global economy the benefit of the doubt that these central bank responses will probably start to see a slight pickup in economic activity into the last quarter of this year. Amcor's a high conviction buy down here. Full value back up at around $15.50, $16. Look to sell calls up at those levels. AMP not doing there at the moment. ANZ's been ANZ, NAB, and Macquarie have been our preferred banking exposure. ANZ's in the model portfolio, and globally you're seeing the banks recover from among other things, the interest rate. The yield on interest rates are starting to kick up a little bit, which generally acts as a slight tailwind for bank earnings. But what we've seen really is a rotation in global markets where money's come out of yield-sensitive areas like utilities, infrastructure, real estate investment trusts, healthcare. Money's come out of those names, out of the safe haven area of the market, and it's gone back into financial services or banking stocks have been sort of one of the better performers over the last week, and to a lesser extent energy prices. Now the news that's come out over the weekend with the drone strikes on Saudi Aramco oil facilities, we can expect oil prices to be well supported this week, and we'll have a look at that when we get to Woodside Petroleum. But for the time being, the banking sector, there's momentum there, so we continue to like ANZ, NAB, and Macquarie. APA Group, so this is so one of the big themes to think about in the market this week is that the sell-off's been in those yield-sensitive names, and is it time to start stepping back into those names and buying them? And on a select basis we have been. APA is not our preferred allocation, but it is in the model portfolio. Support there at 10.50 and looks to be trending higher. ASX is an example where this has been a little bit of a safe haven hideout. And the sell-off that we've seen is a combination of two factors. Money coming out of those safe havens going into sort of banking sector as an example, but also the takeover bid that the London Stock Exchange has had by the Hong Kong Stock Exchange. Maybe at the margin that's impacting sentiment around ASX. There was speculation that it would either be Singapore or Hong Kong that would eventually make a takeover bid for ASX. So if they're making the takeover bid for the LSE, maybe the thinking is that that there's less of a premium that should be priced into the ASX. But in a low interest rate environment, a company that's growing earnings at 5% like the ASX is, fully franked dividend, this sell-off is an opportunity to add ASX to your portfolio. So it's now under algorithm buy signals. Anywhere sub 80 ends up being a good entry level for ASX. Horizon, just be patient with this one. Wait for a further sell-off, maybe into the last quarter of this year. A dip back to a sort of 525 with buyers of Horizon. BHP should be in the portfolio. It's under algorithm buy conditions. And in order for the XJO to push up and make new highs, a combination of the banks and the resources are going to have to do the heavy lifting. The resources have underperformed mainly because iron ore prices have fallen from, say, 115 a tonne down to 80. They're starting to recover back up to 90 a tonne at the moment. But BHP, Rio, Fortescue are all stocks that are in the model portfolio and under algorithm buy conditions. BHP should be able to push back up and retest $40 as part of the XJO going up and retesting the recent highs. Brambles, low earnings growth, probably something in the order of 2 to 3% earnings growth, but down here at around $11, the stock's back at fair value. I'd warned about it being overpriced, but $11, happy to step back in and be buyers of Brambles. CBA, just avoiding this, preference being Macquarie over CBA at the moment. Cochlear has been added into the model portfolio. We see support here at around $200. Cochlear's earnings, I think, are growing double digit, up around maybe 8-12% from recollection, but the higher low there at around $200 we suggest having to think about adding Cochlear to portfolios. Coles was under buy conditions here at $13, now pushing 15. The big story with Coles is the large cost out exercise that the company's doing. They're stripping out almost $1 billion in costs, which is just an extraordinary number over the coming years, which is going to help to underpin the profitability of the business. So I think for that reason, probably a name that you start to think selling call options over up at these levels. Not sure there's too much more upside in the short term there. Computer share, so this has been one of the stocks that we'd spoken about as a short within the market. There were structural issues that the company faces. The stock's corrected 25% from $20 down to $15. Right at the moment, the bullish momentum in the market and the probability that it carries computer share back up to maybe 1650, but ultimately it runs into resistance and trades lower again in the next wave down. CSL was under buy conditions as it has been for a number of years, but the most recent entry level here was around 175 and the stock's now pushing 230. Caltex is under sell conditions. You can see there the bearish structure in place there on Caltex, and therefore it's not in the model portfolio. So here's a first example of where these, in this case it's a REIT, but the yield sensitive names that are starting to come back into the algorithm buy conditions. So the correction that we've had from 14 down to 12.20, Dexus is now under buys. Fortescue was under buy condition following the retracement back there to $657, now pushing 9. Goodman Group, so I add this to the high conviction list along with Amcor. The ultimate sort of point where Goodman Group finds support, I've kind of given a range here from say 1250 up to 1350, but we're certainly on the first part of support here at roughly 1320. Goodman Group got onto a pretty compressed dividend yield. It got down to about 3.1, 3.2%. There's no options over it, so it's hard to sort of add income to it, but it's certainly one of the better growing REITs within sort of the top 50, top 100 stocks. Goodman's delivered 10% earnings growth in FY19, and they're forecast to deliver another 8 to 10% earnings growth over the next 12 months. So for that reason, we're a buyer of Goodman Group on this dip here. GPT, continue to like this name, probably bump along sideways a little more. Yields are roughly around 5%, maybe a fraction under, back up at around 650, sell covered calls over it. Comfortable there that GPT's high quality business and you want exposure to that. Insurance Australia Group switched from sell conditions to buy conditions there at around 750, trading around $8 at the moment. For the next 3 to 6 months, I would see full value at 850, so you could think about selling covered calls up there to enhance the income. James Hardie, we're not doing it there. Our preference is Lendlease. So you've seen Lendlease sign a deal with Alphabet in the US, where they're building, I think the number's something like $32 billion worth of housing, which is just an extraordinarily large number. So the working ham that Lendlease is building up from not only that particular project, but from other infrastructure, housing, unit developments, both throughout Asia and Australia and in Europe. It's a very attractive business, Lendlease, and we continue to look for opportunities to buy that on the dip. Mirvac Group, back under buy conditions now, corrected from $3.50 down to $3. Again, example of the REITs that are now switching to buy conditions. Medibank Private, don't see too much here in the way of earnings growth. They've delivered, I think, almost 2 years now of flat earnings. It's been a beneficiary of lower interest rates and I think regulation sort of outcomes that allowed them to have slight increases in the premium being charged. But at around $3.40, I'd be selling calls at around $3.50 to bring in the extra income. If you're stripping out the dividend and the call option income and getting 10% cash flow, it justifies the risk there with Medibank. Macquarie, this is a growth opportunity. So at the moment, owning Macquarie, owning BHP to get exposure to a leg higher in the XJO. You can see here we've pretty much been under buy conditions since October last year. at around 115. Now the story here with Macquarie, you may recall, they provided they delivered terrific earnings growth in F year 19, but provided a little bit softer guidance than the market was expected. Now there's a bit of a history with Macquarie, with them under promising and over delivering, so we're starting to see the market price in the prospect of maybe something in the order of sort of 5 to maybe 10% earnings growth over the next 12 months, and in that environment it should support Macquarie more in the 130 to 140 range. NAB switched from sell conditions to buy conditions there at around $24. Stocks pushing much higher up towards 29. Newcrest out now. The gold stocks, whether you look across Newcrest, Evolution, North Star, Oceana Gold, they're all now showing up as buy signals. So this weakness that you're seeing as a result of interest rates moving higher, a little bit of excitement about global growth being able to re-accelerate, combination obviously the trade tariff or the trade wars starting to maybe ease a little, and the central banks providing the stimulus. So in the environment, as you start to see interest rates move back up a little, gold sold off, and keep an eye on it. There's probably a little more selling to go just off the back of if the equity market runs a little bit higher, but I would imagine the range to keep, to start thinking about buying Newcrest is somewhere between $30 and $33. Out of the gold stocks, North Star's the most attractive on a valuation basis, and if you continue to read the blog that goes out at 11 o'clock each morning, we're keeping you up to date as to the stocks that we like and the timing on those. Origin Energy, now there's not many shares that we buy that are under sell conditions, but the fundamentals for Origin I think are encouraging. The dividends they're getting from their natural gas project up at Curtis Island, I think they were up something in the order of 45% on the same time last year. It's a world-class project there, and that's a core cash flow asset for Origin. Fair value's back up at around $8.50 as Origin reinstates their dividend, which brings the stock to about a 4.5% dividend yield over the next 12 months as they reinstate their full dividend payment schedule. And that's assuming, so at $8.50 it would put the stock on about a 4.5% yield. So I think it gradually sort of pushes up towards that point, but not too much further. Orica not doing there at the moment. Oil Search preference Woodside Petroleum over the others. Qantas under sell conditions, so we're not doing there at the moment. QBE switched from sell to buy, so it's actually got a fairly bullish structure developing here in QBE with higher highs and higher lows. The last signal there was around 11.25, now pushing 12.50. Ramsay Healthcare under buy conditions. This was yielding around maybe 2.5% at the moment. Looking to grow earnings somewhere around 4%. And we've had the correction from 75 back down to 63. The algorithm buy signals flagging that, and we're starting to see it turn back up. Should get a push in the price back up to about $70 there, and then I'd look to take profit on it. Rio Tinto, so Rio BHP have been strong at the moment. Our preference is BHP over Rio now, but again, in order for the XJO to push back up and retest those highs, you're probably talking Rio getting back up to testing just under $100. South 32 not doing there at the moment. Scentre Group, not much in the way of earnings growth, but the company are buying back shares at present, and it's trading on about a 5.5% dividend yield, so I think it remains reasonably well supported. Stockland's not doing there, under sell conditions. Sonic's under sell conditions. Keep a close eye on this one. If we saw the price back down at about $27, I think we'll see that switch back to buy conditions, and it would be you'd be well served to look at buying Sonic on the next dip. Santos not doing there. Again, preference is Woodside over Santos and Oil Search. Suncorp not doing there. Preference is ANZ, NAB and Macquarie. And now ASX, don't forget keeping an eye on that. Sydney Airport's one of the infrastructure utility, or let's just call them bond proxies or yield sensitive names that have pulled back as interest rates have gone higher. So you've seen Sydney Airports come from $8.70 roughly back to $8. It's a buying opportunity here. You want to get set in Sydney and Transurban, GPT, some of these names coming into the December dividend period, and at the right time get the covered calls in place to enhance the returns. Transurban's corrected from 16 back to 14. Fine support here. The stock's on a little over a 4% dividend yield. I don't expect them to rally hard from where they are at the moment, because it does feel like we're in a little bit of a phase where the market's recalibrating based on some level of global growth picking back up again, and for that reason these stocks are at levels where they'll find support, but they're probably not likely to trade higher in the immediate term. Telstra, so switched now from sell conditions to buy conditions. I've flagged here at around 350, 360. You want to think about adding Telstra into your portfolio. Treasury Wines, we want to avoid that one. Vicinity, that's a property trust that's in the model portfolio. Westpac's not in the model. Wesfarmers is not in the model. Woolworths has done extremely well. It was added back here at around $27, now trading $37. Getting too expensive up here. Wait for a pullback. If we see it back at around $35 and a switch to buy condition there, you want to look at adding Woolworths back into your portfolio. Woodside Petroleum, this makes it on the high conviction list at around $31. This offers good value on a 5% dividend yield, and I think that's something you can have a look at early in the week. And there we are, back to the index. So the view on the market is that, really driven by the European Central Bank cutting rates, the Federal Reserve moving to cut rates in the US later this week, easing tensions around the trade tariffs, we're probably likely to see equity markets find further buying support, and that will see them back up retesting the recent highs. And for that reason, you just want to be positioned around benefiting from that. Thank you for listening in, and if you'd like to discuss the Investor Signals premium account service, or just discuss any of the details in today's recording, please don't hesitate to give me a call using the details on screen.